Hey, best ever listeners, it's your man, John Casmon, and I'm here with another best ever host, Ash Patel. Ash, how are you today?
John, doing good, man. Excited for today's podcast.
Yeah, so this is a little bit different, right? You got two best ever hosts coming together for this show. I got my show, Multifamily Mastery. You are the man that focuses on everything beyond multifamily. And that's pretty much what we're going to talk about today. Multifamily versus non-residential multifamily. But Ash, for those folks who maybe haven't listened to you and your show for whatever reason, they're sleeping. Give us maybe a 30-second rundown on what they can expect when they check out your show.
We do everything beyond multifamily. So office, industrial, mixed use, medical, ground up development, anything that doesn't have residential tenants in it. I've been doing this for almost 20 years, very passionate about it, and equally passionate about opening people's eyes to looking at other asset classes beyond multifamily. All the books, all the podcasts, all the YouTube videos have a very single-minded path. Buy a single family rental, buy a duplex, buy a fourplex, go on to bigger deals. And there's a lot of other avenues, and we'll get into those today.
Yeah, I love it. For myself, I'm the host of Multifamily Mastery, and we do the opposite, right? We focus on multifamily. We have done exactly what you talked about. We bought duplexes, we bought 8-unit buildings, 3-unit buildings, got up to kind of the 20-unit building range. Now we do larger syndication deals, 100+ unit apartment complexes. We're buying a couple, selling a couple. So that's kind of where we're at. And we love multifamily, and, I think we like everything else. So to be clear, this is not saying one is better than the other, don't do this or do that. But we do think it's really important for us to understand that there's different strategies and ways we arrive at the strategies we select as investors. And we just want to dive into the psyche a little bit more and get into some pros and cons, and quite frankly, give people a chance to open up their mind for what values and what opportunities exist. So, before you hit record, you kind of were just sharing that, hey, you actually started in multifamily, had a lot of success in multifamily before kind of transitioning and pivoting away from it. Can you maybe just give us more of your background when it comes to investing, and exactly what was the trigger to make you say, hey, you know what, I need to start looking beyond multifamily?
Yeah, so I didn't start in multifamily. My very first building was a mixed use building, right? So it had retail on the bottom, apartments above it. So I was able to see how the apartment tenants were destroying my place. I'm unclogging sinks and toilets, patching holes in walls. And my commercial tenant ends up remodeling their own bathroom, puts $30,000 into replacing their entire HVAC system. And I thought, okay, what a pivotal moment. Commercial tenants improve your property on their dime. Shocking to me why anybody would do residential. Now, over the years, I've bought apartments, I've bought single families, I've bought all of it. I've also passively invested in Ashcroft Capital for many, many years, up until 2019. And that was great. Huge negative K1s, steady stream of income. It was a great investment. But over the years, multifamily has just become way too competitive. The returns have steadily gone down. And the current state of multifamily, we should probably talk about current state of these assets, but the current state of multifamily is not great. And I attribute that to a couple things. One, people claiming they got caught with high interest rates. Well, we all knew they were coming. We didn't know when, but we knew it was going to happen forever. And two, the overwhelming competition. John, I speak with a lot of people, and I'm sure you've seen this, where you put an offer in that you think is a really aggressive, good offer where you could probably close in this multifamily deal, and there's always somebody willing to overpay. I hear this a lot, right? There's so much stupid money in multifamily, so it's hard to get deals. And because of that, the returns are marginal.
Man, you said a lot there that I think is really worth breaking down a little bit more, right? So first and foremost, you had success in multifamily. You talked about that first property being mixed use, where you saw, and it's a great illustration, right? The residential residents, well, they were tearing up the property. You had to fix it. They were, destroying the property, as you said it. But that commercial resident or that commercial tenant, they were actually fixing up the property and adding value to the property. So you saw that distinction right there, clear as day. You made some great investments on multifamily, had great success, great returns, but you started to see two things happening. One, the returns started to slow down and the competition started to increase. And those two kind of play hand in hand. And I think it's one of the challenges that a lot of people have faced when it comes to multifamily. I know that's certainly a challenge we faced in our business. I think when we went full time about 6 years ago, every year I had on my goal board over here the amount of deals that I wanted to do. I've never once hit it, right? Because in my mind, we were going to do a deal every quarter, but the competition was so strong. We couldn't find deals that penciled at the numbers we liked without us maybe being very optimistic with certain factors. So we just never got to the deal flow that we were looking for. So what you say makes a lot of sense. And I know it's a pain point many investors recognize. You mentioned that was for you was around 2019. What was the transition for you at that point?
Our returns on our own deals were so much higher, and the multifamily returns were coming way down. So it was just a natural progression to put all of my available funds into my own deals versus somebody else's.
That makes sense.
By the way, you could thank Joe Fairless for the increased competition. He's single-handedly educated tens of thousands of people. He wrote a Bible on multifamily investment, 400 pages. Yeah, John's pointing to it on his shelf there.
That's right.
I've had it on my shelf for probably 15 years. I've never read it. I probably should. But yeah, listen, the conferences, a couple thousand people go there. He has opened up his entire playbook to the world, and people have literally followed that path and become very successful.
Yeah, I mean, listen, Joe, obviously a great friend of both of us, definitely did a great job educating people. And it's one of those things too, like, I know a lot of folks like to look at historicals and say, oh, well, this happened in 1937 or 1962. And listen, all of that's great. The thing that people miss whenever I'm hearing these people tell these stories is the impact technology and laws have on kind of the landscape of the markets. And what I mean by that is, if you go back to prior to the Jobs Act, you couldn't syndicate the way people are doing today. So back then, you couldn't get together with a handful of friends, post something online, and go and raise millions of dollars from pretty much strangers to go and buy a property, right? You and I had to know each other and kind of put our money together and put our nickels together to go buy a property. So it really limited the resources and the access people had to these kind of deals. But with the Jobs Act, with the growth of not just technology and the internet, but social media, it's so much easier to connect with people and to raise capital for these deals. And all that combined allowed this to grow. Not to mention, we were coming out of a recession where everything was depressed pricing back in 2011, 2012. So you pretty much had to ramp up for about, 8, 9, 10 years where everything was going up in value. So some of it is timing, some of it is technology, some of it is just what's available. But looking back, I just think too often people associate, valuations with like, oh, well, back in the 80s, this happened in oil prices. I get it. I understand. But we also have to understand that some of the fundamentals have shifted where it's not just those day traders, those investors. Your everyday person is listening to a podcast like this and can ideally get enough information to go out there and buy apartment buildings. So I think what you're saying is spot on. And that certainly created a ton of competition. So you said that you were looking at your own deals. And you're like, I'm getting way better returns in my deals than I'm getting these apartment deals. I'm just going to pour my money there. Talk to me more about the deals you were doing.
So Fairless actually spoiled me because back then we were getting over 20% annualized returns on his deals. So that set the benchmark for my deals. If I'm going to do all the work, take all the risk, I need to get way above 20% on my returns. And that's annualized cash on cash returns, right? So that's been the benchmark for our deals from day one. And so, I don't care what it is that I buy, office, retail, industrial, medical, ground up development, as long as I can make a lot of money, I'll put my money into it. And as long as the risk is mitigated, right? But John, you brought up a point about raising. Tell me the current state of multifamily and investor sentiment. Did you just say you closed on a property recently?
Yeah, we're supposed to close Friday as we're recording this here on a Tuesday. Our closing is pushed back to tomorrow, so we'll close tomorrow.
Congrats.
Thank
Tell me
you.
about the deal.
133 units in Columbus. It's a B class value add deal. We're gonna pour a little bit of money into the renovations and hold it for probably 5 to 7 years or so.
Was there a raise involved?
There was absolutely about $6 million.
How difficult was that relative to past raises?
Extremely, much more difficult. So, I mean, as you know, I think investor sentiment has soured for a multitude of reasons. One, the overall economy is just soft. People are more concerned with their own jobs right now, so there's not as much capital liquid to invest. Multifamily as a sector certainly hasn't performed as well for folks who have been in syndications. So we've seen that shift a little bit. I will say for us, our deals have performed pretty well, and the Midwest as a whole has seen much more success than some of the deals along the coastal markets in the Southeast region. So from that standpoint, I would say almost every investor was a repeat investor who has seen kind of how we operate, seen the experiences that they've had with us, but not as many newer investors on that deal. And we ended up having to bring in, I shouldn't say had to, but we ended up bringing in an institutional partner because we did anticipate that, hey, this is going to be a little bit of a more challenging raise than what we were used to.
I'd love to contrast that. We just closed on an office project in Louisville, Kentucky. And I was extremely nervous because I know investor sentiment is not at an all-time high. There's a lot of people that are jaded out there. Stock market's at an all-time high. People like us that have lived through some market cycles know this doesn't last forever. But nonetheless, office right now is one of the most toxic assets you can imagine. So I was really nervous about this raise, but we ended up raising $3 million in about 20 days. And a lot of our investors had previously invested in multifamily, and they all had deals that either had cash calls. Some of them lost all of their money.
Oh, man.
And, I thought a handful of people are just done with real estate.
Yeah.
But a lot of our investors were previous multifamily investors, right? So investor sentiment is shifting. The best ever conference, there was a lot of people looking for diversity into other assets, retail, not office. Like really, no one's raising for office. No one's biting on it. But I was shocked how many investors we got for this deal. And each investor put 50, 100 grand in, right? So maybe, 40, 50 investors that came in, all for an office deal.
What do you think it was about that deal that was exciting for people to raise? Because you said you were nervous at first. So sounds like the level of interest exceeded your expectations. So what was the feedback you got from those investors of why they felt comfortable with an asset class that really wasn't in demand for the last 5 years? And certainly I'm not reading anything that says, hey, office is crushing it. So what is it that made this deal or this opportunity exciting where you were able to exceed kind of your expectations?
Part of it was educating our investors in that we have a once in a lifetime opportunity to buy office for pennies on the dollar. 2, it's basically 16 buildings that we bought, and we bought them for $3.5 million. So it comes out to just under $220,000 per building. Now, those 16 buildings were built at the exact same time as 8 other buildings. So the total number of identical buildings in this complex is 24. Well, some of those 24 have sold for $400,000 and $500,000. So our thesis on this is very simple. We buy each building for 200, sell them off individually for 4 or 5. Right. So there's not many buyers out there wanting to buy 16 individual buildings as a package for 3.5 million and inheriting 60 different tenants. Like onboarding that is a big deal. Managing that is a big deal. But just think outside the box a little bit, buy it as a package, break it up, sell it off.
So there are a couple things that stand out to me, right? So for folks who are trying to understand, like you had a built-in comp, right? High comps, right? So you're buying this thing for about $220 a door. So you have comps in the $400,000, $500,000 range. So people could immediately see the value that you were going in with some instant equity, or at least the ability to get up to that equity relatively quickly. So I think that's really helpful for people. But then the other thing you started to allude to is just being more creative, right? Like understanding, and this is the thing that I think multifamily suffers from is there's not a whole lot of room for creativity. It used to be, I think back when you were doing those deals with Joe and, when I started investing, especially in apartments, I could come in and literally that value add business plan, that's all I needed, right? Because somebody else was saying, hey, what's the current NOI? Okay, great. I can offer you X. And if you had a value add mindset and said, okay, what's the current NOI? But I can do this to that unit and I can increase the value here and I can push rents $200 and the NOI is going to jump up here. All right, now I know kind of my margins and what I can pay. That was innovative for multifamily 6, 7, 8 years ago. That is table stakes today. Like everyone assumes you do. Every broker package I see has the value add plan built into the OM, right? So you're not fooling anybody or you're not coming up with anything creative or original when you're looking at it that way. And I think that's one of the biggest challenges that multifamily faces is you can be creative in different asset classes because there's room for it too, right? You can have a completely different business plan that the broker or other investors have never even imagined. Whereas there's very little room for creativity in the multifamily space. I mean, yeah, you can add a dog parking. Yeah, you can, build back for utilities or whatever it is. But like, I promise you, if there's 50 other groups looking at it, 45 of them have already put that into their underwriting as well.
The playbook's been written on multifamily, right? Which is why when they do a call for offers, all of the offers are very tight. I interviewed somebody a while back and they said, look, anybody looking for a partner in multifamily, do not partner with a visionary. You don't need creativity. You just need a worker. Hire an integrator. Hire somebody willing to just pull their sleeves up and work. But John, in our world, creativity wins. Another example is we have a building in Canton, Ohio. It is 80,000 square feet. Home of the
Pro Football Hall of Fame.
Yes, sir. 80,000 square feet. We're buying it. Well, it's under contract for $8 a square foot. Keep in mind, build cost is over 300. Replacement cost is probably 400. Elevators, really well kept building, and $8 a square foot is our contract price. We were given 100 days for due diligence, and we told them we're going to start marketing this property under DD. So all we have to do is get a tenant for one floor. If
marketing
we can do
for
that,
tenants, you're saying?
Correct.
Okay.
So we've been working with brokers. Our team's been marketing. We have reached the 100-day point. We asked for another 100 days. They gave us 90. So we now have, and we've got a few tenants interested. It just takes time to negotiate leases and get somebody in for an entire floor. But here we are. We have no money into this deal other than some earnest money. But if we're able to get a tenant to sign a lease, we can buy this building and it breaks even.
Right away with one lease, you're saying?
Correct. For one floor. Right. So that's one example of creativity.
When you say one floor, you said it was 80,000 square feet. How much square feet would that tenant be renting at that point?
It's 4 floors, so 20,000 per floor.
Okay. So with just a quarter of the building, you'll break even.
Correct. And maybe 16,000 of that is usable.
Yeah. Got you. Yeah. I think that's the thing that jumps out, right? So there's someone listening saying, hey, that sounds great. They got the pain points, the frustrations. I can't find multifamily deals. They're not penciling. Sounds great, but here's the rub. I don't get the other commercial or the commercial real estate strategies, right? So when you talk about retail and office, how do I even get started? I know you do a lot of education in that space, but I know it is complex for a lot of people to figure out, right? And typically speaking, in that world, there's a lot more feast and famine, I imagine. So maybe you can just share a little bit more about, what it actually takes to be a successful investor in the commercial space.
Anybody can start out with buying a property near their home, 2 or 3 tenant retail building, small office building. A mixed use building is ideal. Same type of building I started with. To underwrite a mixed use building, the apartments should pay for all of the expenses. The retail or whatever the first floor is should be all profit. This way you've got a safety net, bit of a stopgap, right? Most of our listeners probably know how to underwrite multifamily. So if they can underwrite a mixed use building and the apartments pan out, perfect. Now, the other thing that holds people back is fear. It's fear of two things. One, they think it's too expensive or it's too risky or it's too difficult. And I'll give you two examples. One, I can find or commercial building in probably most markets that is the same price as the average single family house. So I'm talking like a little mom and pop shop that cash flows very well. Two, I want to share another example. I had a building in Cincinnati, Ohio, and I was going to buy the building next to it. It was a mixed use building. I owned a restaurant in the building. I was going to buy the building next door to put an event center in there. And I didn't want an event center bad enough. So I didn't pursue the building. I got a call from another friend of ours, and he said, Ash, will you help me underwrite this building? I said, sure. Tell me the address. He sends me the address, and I said, look, I own the building next to it, and I'll tell you everything about this building. I'll also tell you that you can buy it for $165. We got the price all the way down. This was 4 apartments and 3,000 feet of commercial with a backyard patio for $165,000. And this person said, man, like, I'm afraid of the commercial. I said, hold on. I'm afraid of the residential. I don't want to manage residential tenants. I said, why don't we partner? He thought about it, got back to me. He's like, yeah, I want nothing to do with this. And I said, well, let me ask you this. If this was just 4 apartments, this same building, drop it down, just get rid of the commercial, same location, what would you value this building at? And he said something like ARV would be like 380. And I'm like, oh my God, why wouldn't you buy it? And, shame on the realtor too, because if they had marketed this as a 4-unit apartment building, all of you guys would be in a bidding war over it. But because they gave you a free floor of commercial, everybody was scared. Knowing that the ARV for just the apartments was 380, I ended up buying this building for not 165, but for 150. I think I ended up selling it as is for like 300.
I love it, man. I love it. And let's get into that, right? Because that fear is, what we're ultimately getting at. And that's where it comes into competition. And I think that's the gap. And, when you start to invest beyond multifamily, part of it is, I think, I'm a guy who I'm more of a hands-on learner. It takes me a minute to really figure things out. I've got to try it out. I've got to test it. I got to make sure that, the thing I read about in a book or the thing I heard about in a podcast wasn't just some dude's blind luck, but like, okay, there's actually a process here. There's, things that I can replicate. There's people who will buy, and there's a real demand for this thing. I know one of the biggest and realest fears people have is, they don't know how to analyze the commercial side, just like you said. So yes, I can buy a mixed use with the apartment rental income, but I don't know how to evaluate the commercial. And when you take out that apartment, and now we're just talking about straight retail or office, well, the questions start to come in. Well, how do I analyze it? What happens if I can't find tenants? What I heard you say on that deal earlier is you had 90 days to start marketing for a tenant. And then you got an extension for, you push for another 100 days, and you got 90 or whatever. So you had 6 months basically to market for a tenant. I think that scares a lot of listeners because it's like, oh man, it's going to take 6 months to find someone to occupy this space. And I think that is the rub is like, hey, if you got people in there who are paying, awesome. But if they leave, I'm sure you and many people have driven down the street and you see the for lease signs. And those signs stay in those windows a long time, man. I mean, where I live, man. So we're both in Cincinnati, and I'm close by Harper's Point, and there's a LA Fitness that's close to my house, and it closed and they moved shop. That for lease sign has been up there for at least 7 or 8 months now, and there's no indication that someone's going to lease that property soon. And I think that's the fear people have. Can you talk about how you kind of navigate that landscape and maybe why that fear isn't real?
Yeah. What's funny is we used to work out at that, it was an Esporta, LA Fitness.
Yeah.
And then they just did not renew their lease. And when they didn't renew their lease, I thought, okay, sure, they've got another tenant coming in. Shockingly, it's still vacant. Yes. So that's one area where multifamily really thrives. If you have an apartment, you're going to rent it. It might be at a little lower price, but John, you can get an apartment rented tomorrow at the right price, right? For us, it's not the same in retail. We can drop the price all we want, but it takes a lot to get a commercial tenant into a retail spot, especially larger footprint retail, right? But I'll also tell you that right now, retail is the healthiest it's ever been in history. It has the lowest vacancy in all of history. So anybody who owns retail right now, especially, the 2 to 5,000 square foot footprints,
Yeah.
tenants are knocking on your door wanting to get in. And we've never had that historically. So yes, that is certainly a risk. There's ways to mitigate that, right? So when we underwrite, we want to make sure that we're going to make money at substantially lower than market rents. If it passes underwriting, in addition, we also look at surrounding vacancy, right? If there's a bunch of retail vacancy in a particular area, you've got some challenges to overcome. But if all the retail around you is thriving and you can point fingers as to why this one property was mismanaged, that gives you a little bit more ammo, right? But again, in due diligence, we can still market for that retail spot, right? We'll have 45 days of due diligence. Day one, we'll take out ads and see what kind of responses we get. But to directly answer your question, how do you underwrite? Our underwriting spreadsheet that we've used for 15 years, 100 of our mastermind members use it. It's 2 columns. It's basic napkin math. It takes you less than 5 minutes to underwrite a deal. If it's not a killer deal, we move on. Or if we don't see something that everyone else doesn't see, we'll move on. And an example of that is a commercial broker had listed an office building way, way overpriced. He advertised it at 20,000 square feet, and you look a little bit closer, and then you go to the auditor site and you realize it's 40,000 square feet. The broker didn't add the second story. So he got no phone calls on that. And what a great deal, right? So we find mismarketed, mispriced, or mismanaged deals. We have other commercial brokers that only list properties on their own website. They don't use LoopNet. They don't use Crexy. Their homemade little website is where they post all their deals. Got a great deal from that. So again, that's where creativity wins, right? Look where no one else is looking. Another really creative approach is look for business owners that are selling a business. Gosh, how does that work? Well, okay. I had a building that was listed as a bar restaurant for sale. It was on a business broker's website, and they were selling the bar restaurant, and oh yeah, the real estate's included. Okay. So this bar restaurant had been closed for 2 years. All the employees just walked out one night. So it's got a terrible reputation. You cannot open under the same name. So I called the business broker, and he's like, oh yeah, we're selling, a bar, restaurant, all the fixtures. And I convinced him that there's no value in the name or the equipment. This is equipment you buy for pennies on the dollar from closed restaurants. So I was able to buy this building at such a steal. The day that I got the keys for it, I opened the doors, go in there. The neighboring bar restaurant owners all came over, and they're like, hey, we've been waiting for this to hit the market. How did you get it? Look where no one else is looking. Again, back to creativity, right? But for anybody that wants our one-page spreadsheet, you can just go to the Best Ever website and Google, or just search for Ash Patel Underwriting Best Ever. They're giving it away.
I love it, man. Listen, I love a few things you said, right? Because, and you and I have had this conversation. Part of this is like, again, I know I'm a little bit of a slower learner, so I just got to put that out there. But here's the deal. Once I got it, I got it. The things you just said, they're the same for finding any deals, right? It's just in your space, there's more opportunity. And there are a couple things you mentioned. You mentioned looking for mismarketed or mispriced opportunities where that maybe that broker didn't add the second story, or they're only listing it on their own website. Those things still happen, right? Now, if you go into commercial real estate, you're dealing with large brokerage firms where they got a bunch of people whose only job is to go and verify every information. Doesn't mean it always happens, but that's their job. That's the thing you get with a large firm. So if you're looking for deals that are maybe mismarketed or mispriced, don't necessarily run to the large brokerage firms that have hundreds of employees and a national presence. look for those small mom and pop brokers who maybe don't have the connections and they're doing the listing themselves. And maybe they put it up at 2 a.m. when they were half asleep, and maybe they had a typo or they didn't double check something. And maybe there's a big mistake. One of the deals we're selling right now, it's a 104 unit property we bought in Louisville, Kentucky. The only reason that deal worked for us is the broker was actually the son of the developer. And when we looked at the OM, it only had 7 pages to it. And I was like, this is the entire OM? And 2 of those pages were the cover and the contact us page. So they didn't have a lot of information. It had no mention of any kind of value add opportunity. And, as we dug into it, we kind of uncovered the opportunity because it wasn't laid out as clearly as we have seen in most deals. And that really was a chance for us to find value. And that rings true for every deal. Again, in the multifamily side, I think everyone understands what they're looking for. So it's harder to find that mismarketed deal or that mispriced deal. But in the commercial real estate side, when you're talking retail, office, industrial, some of these other places, maybe you can find them a little more readily. So I love the points you just gave us there. And that last tip you gave about looking at businesses that are for sale, even if the property is not for sale, I think that's golden.
John, help me understand on a apartment OM, typical, 200 units. What do they give you? Do they give you, rehab costs, comps? They give you everything?
Sometimes they will give you that. I don't see the rehab costs typically. So what they'll typically do is they'll lay out the property itself, right? They'll give you kind of the executive summary of the property overview, how many units it is, the infrastructure, brick, the year it was constructed, whether it has, PVC plumbing or whatever. So they'll give you all of that stuff. And then what most brokers do is the good ones will craft a narrative for you, right? So this is going to be a value add opportunity. A new owner can increase the value by doing X, Y, Z, and they'll lay that out for you typically. The really good ones are going to find comps for you and say, hey, here's a property half a mile down the road, and it's got granite countertops and 42-inch shaker cabinets and this and that, and they're getting $300 more in rent. All you got to do is do the same finishes, and then you can get $300 more rent. So that's what a lot of them will do. Not all of them do that, but most will lay out kind of the value add strategy or opportunity for you, and they will identify the comps that support and justify that.
All right. I'm going to tell you, you might be shocked at this, but in our world, very, very few commercial brokers will do a lot of that work. For the most part, I would say 70% or north of will list out the most basic information. Whatever you see on LoopNet is what you're getting. Pictures, though they might give you pro forma rents, which is in a perfect world, these are the rents that you can get. Often these numbers are so off, but you'll be shocked. A lot of listings won't have a picture. They'll just have the basic address, square footage, and it's your job to call and it's your job to do the legwork. They're never giving you comps, right? Comps don't really help us in our world. So it's a really different ballgame. And I wonder if that's why, I don't know if this is still happening, but back in the day, people used to go hard on day one with earnest money. When you give an apartment broker your offer, you give them hard earnest money. Does that still happen?
We don't do it, and I haven't heard of it as much. I mean, there was a time where, if you weren't going hard day one, they weren't considering your offer. It was that competitive, right? I don't think that's happening quite as much. And in fact, we're listing a property now, and I was talking to our broker, and what he was telling me is there's been a shift over the last, let's call it 6 months, where groups will kind of now, they'll see a deal come across, they'll do their own underwriting first, kind of do their math, and then they'll kind of, ask where they're at. And then finally they will come and tour it, but they're not making the offers. There was a point in time where a deal will come out and you'd have groups making offers day one, trying to go hard, like without seeing it, without, any time lapsing, because it was just that competitive. And that has certainly died down. We're not seeing that as much anymore, but I think what you're getting at is that's the difference we're talking about is, in your world, the brokers are basically just telling you, hey, this property's for sale. But that's it. They're not helping you craft your vision. Certainly they'll answer questions, but their job is not to prop this thing up as this beauty. And I think in multifamily, you're hiring a multifamily broker to tell a narrative and to highlight what this thing could be, not even what it is, but they're selling a vision of what it could be, which is how they justify the higher price point, which is why guys like you and I get frustrated and say, hey, we can't get the returns we're looking for anymore.
Yeah, but in order for people to put money hard on day one, they must lay out all the information. They give you everything, right?
They give you the lion's share of it. I mean, you've got to verify your own data, right? You got to verify what you think. I mean, I'll give you an example. I toured a property last week up in Miamisburg, and it said it was built in 2023, that it was converted from an extended stay hotel into apartments. Well, I got up there, looked at it. Listen, that thing was clearly built in the late 70s or early 80s. Somebody had did a value add renovation, skipped over a couple things that they should have done. And it was not worth, and they took some great pictures, right? The pictures I had looked like it was new and fully renovated. But when I got there, you could clearly see that this was an older property that had been rehabbed at some point and done, okay renovation, but not up to kind of the quality we would like. So sometimes you have it. I mean, on a deal like that, you're screwed, right? You go hard day one and you get up there and you realize you thought this was maybe you put $250,000 into the renovation and you realize it actually needs $1 million. You're screwed. So I would say a lot of times with those groups, if you're going to go hard, one, I don't think anyone's doing it anymore, but when they were doing it, I think they were also either working with brokers who were more trusted. They were, getting somebody out to the property right away to tour it, but they were really verifying kind of their information. And sometimes they were also, they were going hard, but they were okay losing their hard money, right? Because it was the thing where it's like, all right, hey, maybe I'm only going hard 50,000, which still a considerable amount of money. But if you're going hard $50,000 on a $20 million deal, for some groups, it was worth it. And then it was like, all right, well, unless we see something that is absolutely terrifying, we're closing this deal no matter what. And that frightened me too, because now you got groups who are committed to a deal, even though the numbers may have changed. Because again, maybe you thought you needed $250,000. You realize once you get on site, oh, guys, this is actually $1 million. Or you get into due diligence and you realize, hey, this roof needs to be replaced, or hey, this driveway, it's got a crack under the foundation and you're gonna need to replace the pipes. Like, you don't know some of that stuff. Like, you can't possibly know that day one. So those are the things that, I think certainly can come up, and, groups certainly don't boast about that when it happens, but hopefully they have contingency plans when they were making those offers.
John, historically with multifamily, they always did a call to offers. Do they still do that? Like the latest deal that you're buying, were you able to just make an offer, sign a contract, be done? Or was it call for offers?
Yeah. So typically they do a call for offers. They'll have a number in mind. So if you're close to their number and they're in the sense that you're going to be the best buyer, then they'll work with you and negotiate with you. Again, in the past, when there was a frenzy, they use that because they want to pit you against each other, right? Even if you have the best offer, they want you to know, hey, we like your offer, but you're going to have to come with your best number and your best terms, and they'll let you negotiate against yourself, right? Or have this threat that someone else is going to increase their offer. And that's part of the process. And that's a broker's job, right? A broker's job is to get the highest price and the best terms for the seller. And I think a lot of newer investors don't get that, especially if you come from the residential real estate space where you're used to having a buyer's agent and a seller's agent. That's not this game in commercial real estate, right? Like that broker, that agent, they work for the seller. Make no mistakes about it. That is the person they are representing, is the seller. So as a buyer, when you're working with that broker, recognize that their objective is to get the highest price and the best terms possible for the seller. Now, yes, they want to do business with you. Yes, they'll probably want to sell and list the property from you on the back end whenever you're ready to sell. But they know who the seller is. They don't know who the buyer is. And you're one of many. So they'll let you, you can ask your questions. They'll be nice to you and all of that. But make no mistake about it. They're representing the seller. And in that case, if they can create a frenzy or the illusion of a frenzy, that happens. So I did a coaching call last week, and one of my clients was saying like, hey, they had this deal. They were talking to the broker. They hadn't had any offers in 3 months. So they're like, awesome. We're going to go ahead and write up this LOI. They write up the LOI, and within 2 days, the property is under contract with someone else. And it's like, what a coincidence. Like, it's not a coincidence. The broker did that intentionally. They needed another offer so they can go back to whoever they were negotiating with before and say, hey, if you're serious about this, we got another offer. You better move or do something. that broker has no allegiance to you as a buyer. And, it's just the reality of it. They just don't. So keep that in mind when you're negotiating and doing these deals, because that broker's job is to represent the seller and to try to create a little bit of friction and a little bit of emotion. And that's what they do. So we are seeing the call for offers and all that still as part of the process. But I will say, you try to get a pretty good read of how much real competition there is. What we've seen more lately is they'll do a call for offers, and a lot of times they're not getting their number. So then they're going to come back to folks who expressed interest, or buyers or groups that they deem are worthy and credible. And they'll say, hey, man, what would you offer on this? Do you think you get your number up to 3 million? Or they'll figure out with you. You'll figure out where the real number is at that point, because now they're just trying to get a deal done. And you might be the only group who expressed real interest.
In our world, in 15 years of doing this, I've only seen a call to offer twice.
Wow.
And both were recently, and both were on office properties. I can't tell you how many times I see a listing, and I keep a pretty good eye. As soon as these things come out, they cross my desk. I've made offers on these listings that are maybe minutes old. And as soon as I call or get a hold of the broker, they'll say, yeah, we just signed a contract. I'm like, I'll give you way more money. We can't just sign a contract. In our world, there's never a call for offers. If you make a fair price, they accept, done. They never say, well, we're going to see, what other people offer. It just doesn't happen. Right. Which
speeds the game.
Yeah. And I don't like competing with a bunch of people. I'd rather be first and just get a deal done. Right. I want to share something else, or I want to ask you about this. One of the reasons I steer people away from multifamily is the management and the oversight. So when you're ramping up, going from the duplex to the 4-family, 16-family, there's a lot of pain points incurred throughout that process, because you cannot hire a full-time leasing person, full-time maintenance person. You're piecemealing a lot of that, right? Where is that cutoff? Is it 100 units to where you can finally afford to get a leasing maintenance person? Is it about 100 units?
Yes, 75 units to 100 units, kind of depends on the revenue. But yeah, I would say about 100 units or so.
Okay. We had lunch with a multifamily operator in Northern Kentucky a few months ago, and this person wanted to learn more about commercial. So he just asked us a million questions, which is fine. And he had 200 units that he self-manages with a small team. And he said, how do I get away from managing all these tenants? It consumes 90% of our time, all the phone calls, the maintenance requests. And he said, how often do you get phone calls? I had my operations manager with me at lunch, and I said, ask him. And I said, hey, how many calls a week do you get from tenants? He's like, none. I'm like, okay, how about calls or emails? He's like, maybe one. So, he had 200 units, and let's say, revenue, average price of an apartment, $1,500. Is that about right?
Something like that, yeah.
Okay, so $300,000 in revenue. And wait a minute, 200 units. So that's 300,000 per month in revenue. Is that right?
When you're doing math, man, you losing. But that sounds right.
Yeah, 300,000 a month. Okay.
You said how many units? 200?
200.
Yep.
Okay, so $300,000 a month. What are those 200 doors worth on average, do you think?
If they're
50,
doing
60,
if
70,
they're doing
80?
No. Well, if
Somewhere
they're doing
scattered throughout northern
1,500,
Kentucky.
I would just, if you're doing 1,500 a door, let's just use the 1% rule to guess and just say they're worth $150K
Per door?
per door.
Okay, so I'm not good at math. I'm going to 150 times 200. $30 million, right? And his entire team was inundated with calls. At the time of this lunch, we had $50 million in assets under management, and we don't get one call, or we get less than one call a week on average. So point being, managing non-residential real estate is so much easier. I've never had a full-time leasing, maintenance, none of that. Matter of fact, we do a lot of our leasing on our own for vacancies. We manage every tenant I've ever had has my cell phone number and the cell phone number of my team, right? I want that call we typically don't use property managers because if there's a problem, I want the call. So I have an opportunity to make a positive impression. So that should be a pretty good argument about looking beyond multifamily. Way easier to manage.
And not just easier to manage, but also more cost efficient, right? Because your NOI is going to be higher. I mean, we talk about the top line number, the gross income, but your expenses are going to be lower as well, right? Because you don't have the maintenance requests, you don't have the repairs, you don't have the PM elements. So depending on the deal, you may have taxes, insurance, and certain common areas, but you don't have the same expenses that many multifamily operators are going to incur, yet alone the headaches that are come associated with navigating and doing that work. So it certainly can be easier to manage and to operate than multifamily. I think one of the things that I've always wanted to understand is, when we talk about, retail, strip centers, office, I've always had an impression that these were more sophisticated investors. These were folks who were sharks. And, if you made a mistake in this space as a newer investor, you were going to pay. Is that off base, or
Hell
is there
no,
more
man.
forgiveness?
They're a bunch of schlups like me. No.
And here's why I say that, right? I think for your typical investor, right? If you think about the trajectory or the journey that many people follow, they might start with a rental. And worst case scenario on a rental, you can sell it as a house to somebody who just loves the neighborhood, right? You get into smaller multifamily, maybe you get somebody who wants to house hack it. You get into not real, but let's just say you get into smaller but commercial multifamily. I know for me, when I bought that first 8 unit, I'm like, all right, I better make sure this is right, because on the first 2, I had some wiggle room, right? Like there were still residential multifamily. Somebody could come in and house hack and pay premium because they're not looking at it the same way I'm looking at it. They're just saying, oh, someone else is going to pay half of the mortgage. Great. When I got to the 8 unit, I knew that, hey, the only other person who's going to buy this from me is another investor. And that investor is not going to give me the leeway or the grace that I may have if I mess up. Like if my numbers are off, or I misinterpreted a figure, I didn't anticipate insurance or my taxes, I'm just screwed. I'm going to lose money, right? So I know for me, that was the big jump. And I imagine, but the flip side of that was, I always knew if I could cash flow, then I could at least hold the property. When I think about retail, office, strip centers, the concern that I imagine people have, and the concern I would have, is, well, what if I'm not able to find that tenant to lease? What if I made a mistake identifying the right neighborhood or whatever it is, and now I'm not cash flowing because no one's saving me in this land, right? If I mess up and I do my analysis and I thought I could get this thing rented in 3 months and it takes 9 months, I might just be SOL, right? So can you just talk about maybe that perspective for the folks who are interested, that they're sold on everything you said, right? Easier to manage, more creative. I can cool, got it. I ain't got to compete with 50,000 other multifamily guys. How do I make sure I don't F up?
All right. 2 things. You mentioned the type of people buying them. I took a friend of mine to a restaurant. It was in one of our strip malls, 100,000 square foot strip mall, and told him that I own the strip mall. He's like, wait, what? I didn't know people could own things like this. I thought only big companies could own them. No, they're very accessible. Under $1 million, it's a lot of individual investors. $1 to $5 million, it's going to be more experienced investors, very few syndications. 5 to 10 million, it can be partners, or it can be, we sold an $8 million strip mall to an optometrist, but his partner was a property manager, right? So it's typically still individuals. 10 million and above, you start getting into institutional REITs, but under 10 million for the most part, it's people that have been in the game for quite some time and have done well, but it's not typically institutional. Now, the other question, how do you not screw this up? You live within your means, right? I started out with a $230,000 building. I could afford, an apartment tenant not paying rent. Then I progressed, three, four, $500,000 properties, 800 million, 5 million. You have to make sure you can weather the storm. Always play defense no matter what type of real estate you invest in. Again, I've lived through the 99.com bubble, 2008 recession, COVID setback. So I'm very paranoid. I've been expecting the worst since 2015. Literally started selling assets in 15 because I thought everything was at an overinflated price. I was vastly wrong about that. But to this day, we always play defense. I've walked away from a lot of deals that I probably should have closed on. Just anticipate the worst. So the people that I mentor, in the beginning, they'll give me a pro forma and it's as is. And the next one is fully leased. I don't allow that. If I see your pro forma, I don't ever want to see the arrow going up and to the right. I want to see how much more vacancy you can absorb, how much rent decline you can absorb. And that's how we evaluate deals. I can care less if the deal goes through the moon. I care more that you're not going to lose your, or even worse, investor capital, right? So we're always playing defense. Another question for you.
Hey, before you go to that,
go ahead.
I just, again, I think some of this is beyond an asset class and is just understanding how to be a better investor. And what you just talked about is really, really important. I want to make sure I hit this. When you're looking at deals, you're trying to understand how much the property can absorb from a negative standpoint, more vacancy, right? Like what's your break even number? You obviously want that to be lower than where it is today. I think the challenge that we have seen with the amount of demand in the multifamily space is people, they'll say they're being conservative, but they're not, right? They're really being optimistic and they're just tailoring that down slightly from their best case scenario versus really being conservative and saying, hey, listen, here's how much loss this property can absorb before there's an issue. And that mindset as an investor, regardless of the asset class, it protects you. If you really understand what your break-even number is, what it takes to operate the property, making sure you have plenty of reserves and you can navigate and weather any storms, that's going to protect you. It's these frothy, expectations and projections that can get you in trouble. Even if they're realistic, it's not about it being realistic or not realistic, but the goal is to protect your capital and then grow it, not necessarily shoot for the moon. Go ahead. You had a question for me, though.
Yeah. During COVID, did you own a fair number of units back then?
We had a handful. Yeah, we had some properties.
Okay. How was that? Did you have tenants that didn't pay?
So we had tenants that didn't pay. It was laborious. We had a lot of it was a lot of hand holding, right? Understanding the laws, especially from a state. So we had properties in Ohio, properties in Kentucky. Both states were a little bit different in how they handled it. Both had funds set up to support residents. Residents took full advantage of those funds. And one of the challenges that we faced, that deal I was mentioning earlier in Louisville, well, the tenants were taking full advantage, but in order for them to get access to the funds, they had to be late on their payment, their rent. So people were intentionally not paying rent, even though they had the money, even though they wanted to pay, they didn't pay so they can get a notice and get the eviction letter so they could then take it over to this, organization or service and say, hey, I'm late. They're going to evict me. And then they would get a $3,000 check. And we would sit down and say, listen, you can play this game if you want. But I promise you two things are going to happen. One, we're going to hold this against you when it's time for lease renewals. And two, if you play this game and lose, and your timing's off or they run out of money or whatever, like, we're not giving you any grace. Like, if you truly have a hardship, that's one thing. I'm not talking about those people. But the people who were on time and just saw free money, we were like, absolutely not. And it was a pain because in a way, I get it. Like, the money was free. They were giving it to you. And here's the steps you had to take to get it. So I couldn't fault them for doing it. But on the same note, I'm like, we can't run and operate a business where, I can't tell all of our vendors that you got to wait 30 days because I got to, all of my residents are taking care of this. So it was a painful thing, but it kind of allowed us to create value during that time as well.
Damn, had I known that, I would have rented one of your apartments and not paid you. Gotten that free rent.
Hey, we got all the rent from everybody, or it was like, all right, you're out.
So, John, in our portfolio during COVID, I got two phone calls. One from a guy who had a salon and had been a tenant maybe 5-6 years, but had been a tenant in that building much longer. And he called me. I was taking a nap. He had called me. I saw the call come in. I always take my tenant's calls, so I picked up his call. And he said, "Hey, man, I just want to let you know you could deposit my check." I'm like, "What?" He's like, "The rent check. Like, I sent it to you 3 weeks ago. You can deposit it." I'm like, "All right." He's like, "I just want to let you know, like, you're the coolest landlord ever. Thanks for looking out for me, but like, I've got the money in the bank, so I'm good." I'm like, "All right, cool, man. Just want to make sure you're good." He's like, "Thank you for not depositing my check." I'm like, "Yeah, man, I got you." I was just lazy and this check sat on my desk for 3 weeks and I didn't mobile deposit it. But he thought like I was the baddest landlord ever, right?
Oh,
Another
that's
salon, another salon had just rented like 5,000 square feet from us. And the condition of the building that it was in when she rented it was plywood floors, windows with no framing, just single light bulb lights, and primed drywall. She ended up putting $70,000 of her own money, made this into a high-end salon. 2 months later, COVID happens. And in Ohio and most states, salons were targeted. Like, you were not allowed to open. If you cut hair for money at someone's house, you're losing your license. So she calls me and says, "Ash, we just put all this money in. Can we not pay rent this month?" I'm like, "Yeah." Called me the next month. "Hey, can we not pay rent this month?" "Yeah, have at it." And then just without me saying anything, started paying rent again, right? I had one photographer who just sent me an email. She said, "Hey, I can't afford to pay rent this month. As soon as I get my stimulus check, I'll pay next month and this month." I'm like, "Cool, no problem." And she actually did. When she got her stimulus check, paid the back rent as well. So I called her and said, "Hey, that was very noble of you. Next month's rent is on me." She's like, "Oh my God, I was so scared. Like, I was going to lose the place. Thank you so much." And again, like, what is a month's rent? Not a big deal. But in our world, these are business owners. Their livelihood comes from the space that they're leasing from you. If they don't have that, they don't have an income, right? So I've heard a lot of stories where business owners will pay their commercial rent and forego their house or apartment rent because they're probably not going to lose their home as quickly as they would lose their commercial lease. There's no tenant protections in our world. It's just you're big boys and girls. You sign a contract. You have to live up to the contract. There was no COVID moratoriums on commercial real estate, unlike residential, right? And another point to stress commercial is the number of tenants that have put a ridiculous amount of money into our buildings, similar to the salon, similar to, the person putting $30,000 to replace their HVAC. Last month, I rented out a little store that used to be a toy store, and now it's like a high-end soap candle store. When the lady was looking at it, she said, "Hey, do you mind if we renovate this whole place? My husband's a carpenter." "No, have at it, as long as it's tasteful." She ends up redoing floors, walls, lighting, everything. And I got an email from her husband. He said, "Hey, by the way, during renovations, we found asbestos in the building. So we've got a remediation team coming out this weekend. You might just see a bunch of plastic and dumpsters and stuff." And I thought to myself, oh my God, like had I known, like I would have paid for all that. He didn't even ask, just did it. John, any bar, restaurant that we have as tenants, it's in our leases that if they ever leave, all of their equipment stays behind. Even stuff on wheels that they can easily put onto a moving truck, they have to leave everything behind, right? So every time we have tenant turnover, we have an improved space. Whereas with apartments, every time there's tenant turnover, you got to go in, check the flooring, patch the walls, paint, right? And fix all the stuff that they broke.
I have plenty of tenants who leave stuff behind.
Not the good stuff.
Not the stuff you want, but yeah.
Yeah.
No, listen, I think you make a very compelling case, right? And this is why you're focused on investing beyond multifamily. And if I'm summarizing it, you can get better returns. It's and I mean this in the best way, but it's more fragmented, which is, as investors, you've got to create and find opportunities, right? And that's what we're looking for. And I love that, there's obviously some pros and cons when it comes to multifamily. I think for me, it's the, like, I understand that space. I just understand what it takes to create value. To your point, it doesn't take a lot of innovation necessarily. It does take good patience. It does take, some other skill sets, but there's definitely a lot of things to like when it comes to, expanding beyond multifamily, especially if you have some experience in multifamily, right? And some of those pain points, once you feel them, you're like, okay, you know what? I think I've done that enough times, and maybe there's some other ways to invest. And I think my big takeaway is this. I think real estate is a powerful tool for anyone to create wealth for themselves and their family. The strategy you employ is up to you. If you don't want to deal with tenants, you don't have to. There are ways of doing that. You can do private lending. You can do passive investing and syndications. You can go in commercial. There are lots of ways, but figure out what you want and figure out the best strategy to get it. This is just another pathway for you to explore. Ash, for folks who want to learn more about investing beyond multifamily, what's the best way for them to reach out or get in touch?
I'm very easy to get a hold of. LinkedIn, Facebook, website is Invest Beyond Multifamily. If you Google Ash Patel Cincinnati, easy to find. John, question for you. Have I convinced you to invest beyond multifamily?
So yes, but you've convinced me. I think you've answered some of the questions I have. And I think for me, the biggest answer, I would say answer you gave was how to get started. And it's simple, but it's investing small. It's the same with anything else, right? Like, you just have to get started. And for me, we'll talk offline, but I'm looking at renting right now. Just, I don't think I'm going to be able to find it in time to buy. But I'm looking at leasing a flex office space right now. And even going through that process, now I'm actually looking at properties and I'm seeing exactly what you're talking about. Like, a lot of them are like 95% occupied or 97% occupied. I'm like, okay, there's strong demand in this space. And it's all the stuff that you were just hinting at. So there's definitely great value. I would say for me, will probably be more niche, because I think office I still have a lot of concerns with and other things, but there's definitely some like retail and strip center and flex spaces that I do think are really appealing and make a lot of sense. So I think everyone should explore investing beyond multifamily, right? It's about building a portfolio where you're comfortable, you've got confidence, and then you can kind of control what your investments are doing. And some of that's going to be passive investing. And I love multifamily. I think I'll always do multifamily, but there are other strategies too. I mean, I like, boutique hotels and short-term rentals and things like that. But what you hint at when it comes to not having to deal with tenants, having more creative deals, having more cash flow, that's very appealing, and obviously there's some downsides when it comes to the leasing timeframes. But again, if you can learn that space, navigate it, I think you can make a lot of money. And clearly you've done that.
Well, John, thank you very much for your time. Great conversation with you, as always. How do people get a hold of you? How do they reach out to you and learn more about what you're working on?
Yeah, absolutely. So you can check out our website, casmoncapital.com. If you are interested in apartments, even after all the stuff we just talked about, we did put together a free guide. It's 7 questions you must ask before investing in apartments. And while it's catered to apartments, I think a lot of it applies to investing in general. So you can check that out at casmoncapital.com/7 questions.
John, thank you again. And hey, best ever listeners, thank you for joining us. If you enjoyed this episode, please share, subscribe, leave us a 5-star review, and have a best ever day.